Short payoffs and tax implications. Objectives. The objectives of this chapter are to dominate how short payoffs work, clearly distinguish the two short payoff types, and understand short payoff tax implications and solutions. Owners of over-encumbered properties in foreclosure face only three possible options: reinstatement, sooner or later bringing the loan current; foreclosure, losing the property to the creditors; and the third option, the short payoff. This is the subject of this chapter. Short payoffs. Definition. A short payoff is the transfer of title over a property for less than the value of the debt secured by it. Creditors release their interest in a property for less than what they are owed. The creditor is paid short of the full payoff of the debt. Thus, short payoff. The reasons creditors accept short payoffs are logical. The collateral is worth less than the debt. The creditor's equity position is compromised, and the result of the foreclosure sale will be worse for them. Types of short payoff. There are two types of short payoff: short sale and release of lien. Purchase money and non-purchase money. To clearly comprehend short payoffs, it is important to first understand the concepts of purchase money, non-purchase money, and deficiencies. Purchase money. Purchase money is money borrowed for paying all or a portion of the purchase cost of the primary residence. Purchase money is borrowed simultaneously with the purchase of the property. It can be secured in any position. Non-purchase money. Non-purchase money is any borrowed money secured by any real property which was not used for purchasing a primary residence. Non-purchase money can be secured in any position. Purchase money qualifications. What qualifies as purchase money is always clearly defined by each state's laws. In most states, the concept of purchase money applies only to a debtor's primary residence and the primary residence of dependents. Most states have dollar value limits on what can be considered purchase money. Some states consider certain narrowly defined refinances as purchase money. Purchase money scenarios. These scenarios illustrate the concept well. Money used to buy a primary residence. Money borrowed to lower the balance of existing purchase money loan. For example, I borrowed $20,000 to lower my original mortgage from $80,000 to $60,000. In most states, that is considered purchase money. Money used to purchase a dependent's primary residence. For example, I borrow money to purchase a home for my elderly and dependent mother in which to live. In most states, this is considered purchase money. Non-purchase money scenarios. Non-purchase money is anything that does not qualify as purchase money. Cash out second mortgage. The second mortgage that I took to pay off bills is non-purchase money. Most refinancing. If it does not lower the initial purchase money debt, it is typically non-purchase money. For example, I refinanced into a lower interest rate, but now I owe $90,000 instead of $80,000. In most states, this will not be considered purchase money. Home improvement loan. If I get a second mortgage to fix the roof or improve the kitchen, it is not purchase money. HELOC, home equity line of credit. Secondary residence financing. What I borrowed to buy my beach house is non-purchase money. Construction loan. In most states, until I actually move in, what I borrowed to build my new home is non-purchase money. Investment property financing. The loans on my apartment building are non-purchase money. Big dollar value primary residence purchase loan. I buy my primary residence with two loans. The second loan is for $1 million. In most states, this will not be considered purchase money. Purchase money and non-purchase money implications. The difference between what is considered purchase money and non-purchase money are great. These are the implications. All states provide at least some level of purchase money protection. Non-purchase money does not have protections. As you will see later, this significantly affects short payoff and foreclosure outcomes. Purchase money protections. Purchase money has protections that truly shield a homeowner. Purchase money is non-recourse, or at least partially protected in most states. This means that creditors cannot collect on foreclosure losses. Most states do not allow deficiency collection of purchase money debt, even with judicial foreclosure. This means that after foreclosure, the homeowner walks out debt-free. Because of this, creditors secured by purchase money have more to lose and are typically more cooperative because a short payoff is their only option. Non-purchase money exposures. Non-purchase money has no protections. The consequences of foreclosure are highly penalizing to the homeowners. In some states, creditors can collect on foreclosure losses even in non-judicial foreclosure cases. This is called deficiency. The debtor remains obligated to all debts no longer secured by the property. Foreclosure does not free the homeowner of debt. Although it can be very hard to collect, creditors have less to lose and more options. Non-purchase money debt can only be eliminated by short sale and bankruptcy. Because of this, non-purchase money defaults are the source of the best short payoff opportunities. This brings us to the subject of deficiencies. Deficiencies. Definition. A deficiency is the payment shortfall suffered by a foreclosing creditor when the proceeds of the foreclosure sale are insufficient to satisfy the debt secured by the property sold. A deficiency includes the entire remaining debt value, not just the principal. Typically, interest continues to accrue. Deficiencies are usually not immediately collectible. The concept of deficiency only applies to the foreclosing secured creditor. The concept of deficiency does not apply to unpaid or partially paid secured junior creditors. This brings us to the subject of sold-out juniors. Sold-out juniors. A sold-out junior is any unpaid or partially paid junior loan no longer secured by the property because of foreclosure. Unless it is purchase money, the debtor remains obligated to perform on the debt. The security interest on the property no longer exists. The obligation becomes unsecured debt. The promissory note is still legally binding. Sold-out juniors tend to be difficult to collect. Creditors typically claim uncollectible debt from insolvent or bankrupt debtors as a tax write-off from bad debt. Collectible debt promissory notes are typically sold at a high discount to note-buying collectors. Sold-out juniors are the source of the majority of short sale opportunities. Collections are difficult for the creditor and unpleasant to the debtor. Deficiency judgment. A deficiency judgment is a personal judgment against the debtor in favor of a creditor who suffered a deficiency. A deficiency judgment is what makes a deficiency collectible. Deficiency judgments are enforceable by law. This means that all collection actions, including wage garnishment and liens against personal and real property, are enabled. Judicial foreclosures typically have built-in deficiency provisions. With non-judicial foreclosures, deficiency judgments need to be obtained by separate court action. Non-judicial foreclosure does not invoke the use of the court. It is not easy for creditors to obtain deficiency judgments after foreclosing non-judicially. The only solutions to a deficiency judgment are debt payoff or bankruptcy. Most states have anti-deficiency laws for purchase money debt. California is one of them. Since court action is very expensive, this type of litigation tends to occur mostly with high dollar value debt, such as commercial and construction loans. This brings up the subject of non-recourse loans. Non-recourse loans. A non-recourse loan is one in which the debtor is not personally liable for any loss incurred by the creditor due to foreclosure. There is no deficiency judgment possibility. In a non-recourse loan, the creditor feels extremely confident about the value of the collateral. Non-recourse loans tend to be low loan-to-value commercial and new construction loans. All non-recourse loans must include specific language such as, "This note is without recourse," in the documents. By definition, purchase money debt is non-recourse because homeowners are no longer obligated to the debt after foreclosure. The concept of non-recourse loan tends to relate more to commercial and construction lending. Short payoff solutions. As you can see, non-purchase money debt problems do not end with foreclosure. In fact, they usually get worse and last for years. The only solutions to deficiency judgments and sold-out junior collections are debt payoff and bankruptcy. The only alternative to this is a short payoff. A short payoff provides a negotiated solution for both the creditor and debtor. The short payoff solution depends on the kind of debt secured by the property, purchase money or non-purchase money, collateral value, and the financial capacity of the debtor. Short payoffs. As mentioned earlier, there are two types of short payoffs: short sale and release of lien. This is extremely important. The difference between these types of short payoff is huge. It is crucial to clearly be able to distinguish between the types of short payoff. We can't emphasize enough that not knowing the difference will lead to great trouble. Short sale versus release of lien. Short sale definition. A short sale is a settlement in full for less than the total debt value. The remaining balance is forgiven. The homeowner no longer owes anything to the creditor. The homeowner's personal obligation to perform on the debt no longer exists. The creditor takes a loss. A short sale is debt relief. Release of lien definition. A release of lien is the removal only of a creditor's security interest in a property for less than the total debt value. Release of lien is also known as lien release. The remaining balance is not forgiven. The homeowner still owes the unpaid balance to the creditor. The homeowner's obligation to perform on debt continues. The creditor does not take a loss. A release of lien is not debt relief. Typically, creditors first attempt release of lien prior to short sale. Short payoff settlement. A short payoff settlement is an agreement between creditor and debtor delineating the final resolution of the debt secured by a property. It is presented to the debtor in the form of a settlement letter. Short payoff settlement letter. A short payoff settlement letter is a letter stating the short payoff settlement. The settlement letter is also known as demand letter, payoff demand, or other similar names. This document states the short payoff terms, serves as final escrow instructions, and includes an expiration date. Settlement letter critical issues. These are the most critical settlement letter issues. The short payoff terms must be clearly stated and easily understood. Some settlement letters are drafted purposely very loosely. This can lead to big problems. Request a new settlement letter if needed. A foreclosure attorney should review complicated, wordy letters full of legalese. The distinction between a short sale and a release of lien is in the settlement letter. Short sale proof. The hallmark of a short sale is a settlement letter clearly stating that the debt is settled in full for a specified amount. The debtor is rarely required to sign and return the short sale settlement letter. Release of lien proof. The hallmark of a release of lien is that the creditor states the fact that only the security on the property is released. It clearly outlines that the debt will no longer be secured by the property, but that the homeowner is still obligated to perform on the obligation. Typically, the creditor demands a specific lump sum as immediate partial debt payment. The balance of the debt is typically to be paid as per the original promissory note terms. Sometimes a new promissory note is drafted. Homeowners are always required to sign and return the release of lien settlement letter at closing. To better understand how short payoffs are presented, let's analyze the following settlement letters. Release of lien. This is a good release of lien settlement letter sample. The settlement agreement is clear. It reads, HFC agrees to release its deed of trust only. This indicates release of lien for the minimum amount of $30,000. This is the partial payment due at closing. Due at close of escrow. Our customer, seller, must acknowledge their agreement to the terms outlined in this letter by their signature at the bottom of this letter. They need to sign. This offer shall be valid through June 24, 2005. This is the expiration of the settlement offer. It continues by stating that the remaining principal balance is no longer secured by your home. This means that the obligation is now an unsecured debt. The homeowner is required to sign the statement. I acknowledge, by my signature below, that I have read this letter, understand it, and agree to its terms. The debtors are required to sign. Release of lien affidavit. It is a great idea to, separately, have the seller sign an affidavit of understanding, stating that they will remain owing a balance. This is a good example. Release of lien affidavit. I understand that after the sale, I will still owe a balance. It is even better if the seller hand-fills the statement. Short sale. This is a good short sale settlement letter sample. The settlement agreement is clear. It reads, beneficial agrees to accept as settlement in full. This means that the debt will be totally settled, short sale, for no less than $30,000. This offer shall be valid through June 30th. This is the settlement letter expiration date. Private creditor short sale. Private individuals secured by real property also take short sales. This is a good example of a private loan settlement letter. It was hand-drafted and clearly states, I agree to settle in full. The most important features of this settlement letter are that it has clear escrow instructions and is notarized. A title company accepted this document for closing. Short payoff outcomes. Because of debt relief, all homeowners in foreclosure prefer a short sale, but this is not always possible. For the most part, short payoff outcomes depend on the creditors. A creditor's basis for selecting either a release of lien, short sale, or foreclosure depends mostly on the likelihood of successfully collecting the debt. The present and expected future financial capacity of the debtor will be taken into account. The more difficult to collect, the more likely the creditor will approve a short sale. The easier to collect, the more likely the creditor will only approve a release of lien. These scenarios will better illustrate the reasoning. Short sale scenario. Chances are that an unemployed 70-year-old person who is in bankruptcy will never be able to pay the debt. It will be difficult to collect from this person. In this case, chances are that a creditor will either take a short sale or foreclose and claim a tax write-off for the debt. Release of lien scenario. Chances are that a 35-year-old doctor who is presently insolvent because of a nasty divorce will, as soon as the problems are over, be in a different situation. He has a bright future, will soon be solvent, and able to pay. He will be an easy collections target. In this case, chances are that the creditor will either arrange for a release of lien or foreclose and collect later. Most people in foreclosure fit somewhere in between these presented scenarios. Short sale motivations. If immune to collections, the property owner will most likely not care. A good example is the case of the hypothetical elderly person. Chances of collecting are nil. If exposed to collections and conscious about it, the property owner will be motivated. These individuals have a lot to lose. Motivated debtors always prefer short sales. Who would not like debt forgiveness? Short sales are not always possible for debtors with future paying capacity. These individuals are good collection targets. Release of lien benefits. Good collections targets have no way to walk out of a debt. With them, foreclosure leads to collections. Collections are conflictive situations. To avoid aggressive collectors is indeed a great benefit. A release of lien is an amiable solution. The main benefit of a release of lien is to be in a payment plan rather than in collections. It has lower negative impact on credit. In the case of the hypothetical young doctor, chances of collecting are high. The debtor has much to lose. A person such as the doctor is always much better off with a release of lien than a foreclosure. The young doctor will sooner or later have to pay anyway. The release of lien is basically a payment plan. The foreclosure will result in aggressive collections and even the embarrassment of wage garnishment. The higher the debtor's income, the harder the collectors will press. All this can highly affect an otherwise bright future. Settlement letter caveats. Settlement letters are legally binding documents. It is extremely important to read and understand their exact meaning. In their attempt to collect, creditors will sometimes use tricky, confusing language to later be able to compel a debtor to pay. Consult an attorney anytime a settlement letter is not absolutely clear. Some settlement letters carry a debt reaffirmation clause. This clause will make the debtor re-obligated to debt discharged by bankruptcy. Non-arm's length transactions. Arm's length transactions are transactions between independent and unrelated parties. Non-arm's length transactions are transactions between related, dependent, or associated parties. In principle, there is nothing wrong with non-arm's length transactions, but in the foreclosure and short sale business, they carry risks. In your short sale career, sooner or later, you will be proposed to be party to non-arm's length transactions. Analyze the situation prior to engaging in it. Risky non-arm's length transaction example. Shorting a creditor for the homeowner to sell the property to a brother so that the brother sells the property back to the homeowner is risky. With modern information systems, creditors effortlessly keep track of property ownership for years. This sample document illustrates well the risks of non-arm's length transactions. It reads, Short Sale Terms Acknowledgement. The borrowers, by signing below, understand that the investor reserves all deficiency rights, including but not limited to criminal prosecution. Is any transaction worth this risk? Should it later be determined that we or any third party made any misrepresentations, for example, arm's length transaction, in connection with the origination of this loan or the proposed short sale transaction? Short payoff tax implications. In life, there are only two certainties, death and taxes. The issue is debt forgiveness. Debt forgiveness. Debt forgiveness is the cancellation of debt by creditor intent or bankruptcy court decree. The debt is pardoned. The debtor is no longer obligated to the creditor. Short sales are debt forgiveness because the homeowner no longer owes. Release of liens are not debt forgiveness because the homeowner still owes. Foreclosure sale debt payment shortfalls claimed by the creditor as loss for tax write-off purposes are debt forgiveness. This is because the homeowner no longer owes. To understand how taxation works, it is important to know what is a taxable event. Taxable event. A taxable event is an occurrence that has tax consequences. Any quantifiable financial gain or betterment has tax consequences. Earned income is a taxable event because of financial gain. Debt forgiveness is a taxable event because of financial betterment. These are the short payoff tax implications. Release of lien tax consequences. Because a release of lien is not debt forgiveness, it is not a taxable event. However, since the debt is no longer secured by real estate, the interest is no longer tax deductible. One way to mitigate tax impact is to recollateralize the loan with another property. Another possibility is to pay the debt by getting a mortgage loan on another property. Short sale tax consequences. A short sale is debt forgiveness. Therefore, it is a taxable event. The creditor will report the short sale loss as cancellation of debt. For that, they will issue an IRS Form 1099-C, cancellation of debt. Short sale tax solutions. The best way to tackle tax problems resulting from short sale or foreclosure is to use the service of a foreclosure-savvy CPA or attorney. Because of so many variables, everybody is different. What is certain is that investors and owners of second homes have few tax protections. Homeowners have many safeguards regarding their primary residence. Generally speaking, a debtor is tax exempt if the real property sold was a primary residence and the debtor was at the moment insolvent. The IRS form used for this purpose is IRS 982. This form is downloadable from the IRS website. IRS Form 982, Reduction of Tax Attributes Due to Discharge of Indebtedness. Review. We started this chapter by defining short payoffs. Then we covered the difference between purchase money and non-purchase money. Deficiencies, sold-out juniors, and non-recourse loans were explained. That gave us the foundation to understand the difference between short sale and release of lien. We finished the chapter by understanding debt forgiveness and short payoff tax implications.